Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So that of that 16 trillion, 10 trillion was U.S. dollar based. So of all this creation of bank credit, 10 trillion of that cross-border stuff was U.S. dollar based, or 62%, 62.5%. So you can see, because of the credit crunch, when basically all the swap markets closed down and the interbank markets closed down to give people access to this dollar-based credit that they needed to continue to support these credit lines that they made available. When that all disappeared, you can see the scramble that there was with 10 trillion of this money in U.S. dollar-based, and that coming off the table. You can see now why the Fed had to come in and create all these swap lines to keep these banks afloat. What's interesting is that of all of this cross-border securities, most of these banks, you've often referred to them too big to fail banks. There's 25 of them really that were responsible for all this 16 trillion in credit. Only 5 of them are in the U.S. Most of them are offshore. So we're now in a situation in which the U.S. Administration, through the Fed and the Treasury, is doing more to save people and banks and systems outside the U.S. than they're doing to clean up the U.S. proper. So we've truly become the international bank of last resort in the U.S. And again, who's on the tail end of this? The U.S. taxpayer. And this is why I say we sit here, John Ross and I, when we do our research, in horror watching this. We see thousands of small businesses, hundreds of thousands, close down the U.S. because they don't have access to credit. Private credit to the U.S. economy has actually declined in a very, very big way since this all started. So you think of, it's a nasty situation where the U.S. taxpayer is on the hook for this, but yet none of it, zip of it, is getting into the U.S. real economy to support the entrepreneur. A very, very nasty situation. So it's no surprise why this relationship of pumping this dollar-based credit out into the world in order to save the world on the back of the U.S. system is leading to a weaker dollar. And that is a setup. That's the financial background setup we have at the moment. And as much as we think the U.S. dollar may be undervalued on a fundamental basis, the reality is if this continues to happen, and the Obama administration and the Treasury and Bernanke think it's in the best interest of the global system to sacrifice the U.S. dollar for this, then the U.S. dollar continues to go down. And the winners will continue to be, we think, the commodity currencies, of course, because this momentum move and this very highly correlated momentum move of more U.S. dollar-based credit moving offshore to fund these risky asset classes, to fund China basically for more capital formation in China, means the commodity currencies benefit from this. We also have the commodity currencies tending to have a higher yield advantage. Now, what's interesting, the Canadian dollar took a very, very big hit. The Canadian dollar is a commodity currency. Of the major currencies, the commodity currencies consist of the Australian dollar, Canadian dollar, New Zealand dollar. Canadian dollar took a big hit the other day. Really, it was a sneak attack that we call it, from the Bank of Canada. Bank of Canada came out and said they weren't going to hike interest rates even through 2010. They thought their currency was too high. They were very, very negative, and the currency got hit. We think this may be a short-term event, especially if this situation continues with the momentum going forward. So Canadian dollar is something that we still like in here, and relative to the other currencies, looks very, very cheap compared to the other commodity currencies if this game is going to be kept alive. The euro is up above 150, and it looks very, very rich and is very, very overvalued from a fundamental basis. But the reality is the euro reflects negativity in the U.S. It's the other alternative currency. So again, if this game is going to be kept alive and the U.S. continues to sacrifice the U.S. dollar for global growth, there's no reason the euro can't keep going higher. we say that, but we're very, very concerned and very, very careful here. Remember that stock market correlation with the currencies in here. You almost have to be a stock trader to be a currency trader in here because the correlations are so tight. The U.S. stock market today made a big move, but did not make a new high, so we're watching this. If the U.S. Market starts down and we see a correction, there's no doubt we're going to see the dollar bounce because it's very, very oversold. But that doesn't mean the fundamentals of this change given what the U.S. administration is doing. So we're looking for some type of correction here in the stock market to give the dollar a bounce in order to enter some of these other commodity currencies or the euro at better prices. And that's what the game we're kind of playing right in here, and that's our general view. This is just a little chart that we tend to put together in terms of trend, yield, and environment, currencies that we like the most versus the least. We may have a little change of that last one, but there's three columns there. Of course, the currency is on the left column, the yield advantage is in the center column, and the environment, which is a qualitative measure that we give, is on the right side. And this is something you can do yourself when you're trying to make a currency decision. I think an easy chart like this. Just to give an example of how this works. Number one is the Australian dollar, and it has a big yield advantage, 3.5% yields out of the Bank of Australia compared to 0.2% or whatever the U.S. Fed rates are, close to zero, so it's a big yield advantage. And it has an environment advantage. This growth in China, this really self-induced growth in China because of the massive amount of credit they've thrown into their own economy has been very, very good for Australia. So the environment background in terms of their raw material growth environment is very, very good. As you go down, the negative one that we have in there is the Japanese yen. You've been seeing the yen acting very badly relative to the rest of the currencies, and even when the U.S. dollar is weak, the Japanese yen has been weak lately. The U.S. dollar, we think soon will have a yield advantage all across the board against the Japanese yen, and we think the Japanese Bank of Japan is very much behind the curve, the interest rate curve and all the central banks. And we think that's going to continue to impact or put pressure on the Japanese yen. We think sooner or later the Japanese yen will play that role as a carry trade currency in a big way. The environment is very negative. The Japanese economy really is stuck in a vicious deflation again. The numbers were as bad the last couple of months as they've ever been on the deflationary front. That's a bad thing when you have a massive amount of leverage in your system. Governments consistently count on inflation to bail them out of high debt situations, but Japan is the opposite situation. Massive amount of debt and deflation. So the fiscal situation in Japan is bad and could be getting worse. So that's our favorite trade right there, and Steve could tell you, how to make that trade using the ISC currency options.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.